Very good evening, everyone. This is Rajendran here, joining from Market Calls, and welcome everyone to How to Trade Using Market Profile webinar. So in today's session, what we are going to learn is how to understand the market profile and how we can use it for trading, particularly for a short-term trading purpose, or how I am using for a short-term trading purpose is what we're going to talk about in the today's session. So I thought I'll start with the basic understanding about market profile, how market profile is invented. So if you are able to hear the audio and video quality, just give me a quick confirmation. Just simply type yes in the chat box so that I can understand that we are good to go with the session. Kasim is saying yes, and RPSP Veera Raju is also saying yes. Rajesh is saying yes. Geeta is saying yes. And so thanks for the quick confirmation, guys. So without any further delay, we'll quickly kickstart. So I'm going to start with a picture over here. So what we're going to talk about here is what you're seeing in the screen. So what do you see? What is actually happening there? What do you think? What is actually happening? You can just type it out. Whatever that you're thinking, you can just type it out. So what you're seeing is nothing but the floor trading activity. Right now, we are virtually trading using the trading terminal. We log into our trading application. Via broker, we trade, we virtually meet, buyers and sellers are virtually meeting. But back in those days, that is before electronic era, people physically go to the floor and they meet each other. And they'll be using a mechanism called outcry mechanism. They use hands to buy the call option, put option, or even stocks. They do use those hand signals. Even in Indian markets, we used to have that floor trading. We call it as a BSE ring. This is how the BSE ring looks like. And this is not an exact picture, but you can see that group of people are there. They are yelling against each other, and they are buying and selling the securities. So that is what these floor traders are doing. This is before the electronic era. We call it as a floor trading. But what happened is something very interesting happened after 1987. After 1987, Globex, the exchange, one of the first exchange, Globex exchange, even now it is there. It's nothing but a US market exchange only. So the Globex exchange is the one they're completely transforming themselves into an electronic exchange. Now in India, even though BSE had the floor trading, BSE is one of the oldest exchange. NSE was the first one to introduce the electronic trading platform. Now, because of that only, we are meeting each other against each other. We are logging into the broker's application, and we are now we have a mobile application, web application, desktop application, right? So a lot of modern things happened post 1992 onwards. However, what Peter Stadelmeier is the one who invented a market profile. He used it to, he's an independent trader. He started his career as an independent trader in CBOT, Chicago Board of Trading. So he's been a trader since 1963 onwards. So Peter Stadelmeier thought of visualizing what is happening in the markets. So he wanted to organize the market data in the form of some sort of he tried to visualize the market activity. So he took up a graph paper and then he went to the floor activity, and then he started arranging the market data points in the form of profile distribution. He also served as a director of one of the director of CBOT from 1981 to 1983. So what only in 1985, right? Only in 1985, market profile is introduced to the public. Until then, it is more of a proprietary thing. 1985, the exchange itself, right? So they are releasing a product called CBOT product. As a part of the CBOT product, they are releasing it. So they are also providing the data also. The data is called as liquidity data bank, which is used to plot the market profile data. So this is in 1986. So 1986, Peter Steidlmayer was the one who is inventing. Even he is introducing that concept. Even back then, the markets are in a flow trading activity only. So later on, what is happening here is like markets are converting into electronic markets. And once the electronic markets happened, Peter Steidlmayer is giving all his research material to Jim Dalton. Jim Dalton taking all his research material, and he is the one who pioneered. He was the one who took the market profile to the next level. So now most of the modern principles of market profile are mostly from Jim Dalton. Of course, the base concept is from Peter Steidlmayer, but a lot of advanced, innovative concepts which came from Jim Dalton. Now, I use a lot of Jim Dalton's concept. A little bit about me. My name is Rajendran, and I'm a full-time derivative trader. I've been trading the markets since 2006 onwards, and very actively from 2014 onwards. I designed 100 plus trading systems. I've been observing market profile, order flow for more than 10 plus years. I use a combination of price, volume, and time analysis for discretionary trading concepts. I've been writing and sharing my experience about various trading strategies and trading softwares. I've been writing about various concepts about markets in marketcalls.in. Since 2007 onwards, I've been writing about it. I'm also the co-creator of an automated trading terminal called algomojo.com. So in today's agenda, we're going to look into what is actually market profile. Now, you might had some basics about how the exchange is operated, but let me tell you why market profile, why people initially they started using market profile in 1985 and 86. So that is the time which has been introduced to the public. Peter Steidlmayer was already using market profile for quite some time, but it's actually introduced to the public only from 1985 onwards. Now, I would say, like, compared to any other classical analysis tool like candlestick, it has been invented in 1700 by some rice merchants in Japan. And Heikenhashi, again, a very legacy old technique. Likewise, Elliott wave, 1930s. So comparatively, I would say, like, see, even though market profile is introduced in 1986, comparatively, market profile is one of the modern technique which is used by the traders to understand the market activity, to understand how other traders are thinking in the markets, to understand what kind of emotions are there in the markets. So I would say, like, it is not a technical analysis tool. I would say, like, it is a kind of it gives you an understanding about what is actually happening in the markets. What market profile does is, it is not a classical technical analysis tool, as I said. It is more of a graphical tool. So you can see the graphic and you can understand the graphic, what is happening in the markets and how other traders or investors are positioned in the markets. So it means I visually understand what other traders are trying to do. So market profile does not give when to enter, when to exit. It is not a buy-sell kind of trading system. Right? It is not a crystal ball. It is a way of understanding the markets. Many people think if this level cuts, I should go long. If that level cuts, I should go short. It is not like that. It is more of understanding how the market structure will look like, so that traders can understand, oh, this is how the market will operate. This is how the market will work. This is how the smart money will behave. This is how emotional traders will behave. So this is how dumb traders, emotional traders, they behave in the market. They react in a very similar way almost every time, which you can see it from the market profile with yourself. So maybe if I try to understand what is happening in the markets compared to other traders, I might have a competitive advantage. Because many traders in the market, right, they are looking for breakout levels, breakdown levels, resistance, support. See, market profile never talks about support, resistance kind of things, even though there are certain places you can derive those things. But ideally, it is designed for the traders to tell how the market works on a daily basis. So if you want to know about market profile, right, you need to have some fair idea about auction market theory. Later on, I'll give you some fair idea about what a auction market theory is all about. First, we'll try to understand the profile structure. So how the profile will look like. Now, what Peter Stadelmayer had taken, initially he had taken that half an hour. Every half an hour interval, he started recording the price action. For example, let us say, I'll try to share the whiteboard here. So here is the whiteboard. So what Peter Stadelmayer done is, he tracked the first half an hour activity. Okay, first half an hour activity, let's say, this is the first half an hour of high and low price action. Maybe I'll try to draw in a. Yeah, let's say this is first half an hour price action. First half an hour price action. First half an hour means 9:15 to 9:30. And then another half an hour price action. So let's draw another half an hour price action. Maybe I'll try to put it in a different color. Okay. So I'm not bothered about where the market is opening, where the market is closing. I'm just trying to plot only the activity, high and low. If I know the high and low, that is more than enough. What is the first half an hour? What is the high? What is the low? So I just draw a line to that. Second half an hour, I'm just simply drawing a line to that. Third half an hour, I'm drawing a line to that. Right. So let's say the market is keep on moving up and down, up and down. Likewise, he keeps on drawing all those every half an hour once. He keep on drawing the highs and lows. Of course, there are various ways to do that. I'm just trying to make you understand that every half an hour what he had done initially. So he keep on building those. He tried to understand what is happening. So what he had seen is like a particular price level has been revisited multiple amount of times. And more trading activity has been clustered around the level. So let's say this is a place repeatedly the price action is keep on trading in this band. Repeatedly, prices, even though price is going away, it is coming back into the band. It is going down again, getting back into the band. So this is what he called it as a balance. He called it as a balance. Balance. Now, what Peter Stadelmayer had done, instead of having these kind of candlestick kind of blocks, he replaced with letters. He replaced with letters, and every few points, so we call it as a TPO. TPO means time, price, opportunity. He replaced with letters. Let's say if at all the candle is happening like this is a candle, first half an hour candle. He had replaced it with the letters. Let's say with letter A, again letter A, and letter A, and letter A, letter A. So he replaced the candles with letters. Candles or bars with letters. Every half an hour, a new letter will generate. First half an hour, letter B, A, second half an hour, letter B. So what he had find is like where the market is balancing, why the market is balancing. This is a fundamental question that everybody will have. If you're looking into the market profile, maybe I'll show you the charts of the market profile. You will get very much mesmerized with the way the price action happens. Let me take you to the market profile charts. So I'll go to my Ninja Trader. And in India, right, market profile was getting popular only from 2008 onwards. We start getting more and more innovative tools. And 2011 onwards, a lot more Indian users, they are getting into market profile. And of course, 2015, 16, more and more market profiles, traders are entering into the market. Some traders, they even started using market profile as their full-time trading career. So this is, every day we will be getting a structure. You can see the structure here. This is a structure of what I'm showing you is the Nifty futures market profile structure. Every day it creates a market profile structure. So, for example, let's say I'll remove it and then I'll zoom it out. I'll zoom a particular day. And then I'll show you the structure. If I right click over the charts and if I split it out, it becomes like a split chart, like each and every bar, high and low, that you'll be able to see here. And of course, you can see the market activity, how it is getting tracked. As the market activities keep on developing, you can find that the market is doing something very interesting. You can see that most of the activity is happening in this band. More activity. If I try to compress everything towards the left, so that is what I'm going to do here. I will get a distribution. If I right click and then I'll press everything towards the left, what I'll be getting is a kind of a bell curve shaped distribution. Now, almost Peter Stadelmayer was stunned by this, because on a daily basis, most of the days, he's getting this kind of distribution. 70% of the time, 70% of the time he's getting this distribution. Means very less activity at the edges, more activity at the center, and again, less activity at the edges. So if I start counting how many letters this particular day, how many times a particular price action has been touched. As I said, each and every letter is what? Every half an hour once only, it started forming. Every half an hour once, it started forming the distribution. So if I try to count, let's say I'll try to count at the center, how many letters which is getting traded at the maximum number of letters. So look at the center point. So A, B, C, D, E, F, G, H, J, K. Here I'm seeing 10 times. 10 times a particular price level is getting traded. If I know this information, right, as an intraday trader or a short-term trader, I know that this is going to be on a daily basis. This is what the market does most of the times. If I know this matter, if I know this information better, I can strategize the market in a different way. If I don't know, I will be always looking for a breakout. But if I know this, I know that the breakout in the markets, definitely breakouts will happen, but not every breakout is going to be a successful breakout. Because the market does something called a two-way auction process. It is part of the auction market theory, where the market moves up, again comes down, again goes up, again comes down, again goes up. So again, it comes down. It shows an area of interest. This is the area of interest where 70% of the time, the market trades in this band. We call this a value area. So you can see that the value area is nothing but a red color bracket, which you are seeing. That is the value area. That represents 70% of the letters, 20% of the trading interest, 20% of the trading interest happens over here. More people are interested in trading over here. More volume also happening. If you look into the volume activity, of course, market profile doesn't takes volume into the account. Market profile is purely derived only from the price. Only from the price, market profile is derived. Next to that, what you're seeing is the volume profile. If you see the volume profile, this is a volume profile activity. You can see that where most of the volumes are happening. So 70% of the volumes are also happening at the same location only, more or less. So which one is more important? If you ask me, market profile or volume profile, I would say market profile gives more finer details about the traders and the investors' information. Volume profile also gives information, but not that efficient compared to market profile. So generally, I use a lot of market profile compared to volume profile. I don't even look into volume profile. We can say that. So once in a while, I look into the volume profile, but there is nothing much to decode into the market activity. All right. So what is the underlying mathematics principles behind this market profile? Is this normal distribution? No, this normal distribution is used in is part of the statistics. It talks about probability. I'm sure you might be studying in your high school mathematics. I studied about normal distribution, I think somewhere in my 10th standard or somewhere, either 9th standard or my 10th standard, I started studying about normal distribution. Now, what the normal distribution says is, you can see that 68% of the time is where 68.2 is what the precise is what it is determined by the plus or minus 1 standard deviation. Means, to give an example, let's say there are 100 students in a class. If you arrange them with a height, right? So the people at the extreme are like they are the people having a very smaller heights, and this extreme will be the people with very large height. Like I am like 6.4, 6 feet 4 inch tall, so I'll be at the extreme. I'll be way above 3 standard deviation, because most of the average heights, like among the men, will be like around 5.8 to 5.10. That is what most of the average men will be, like 5.5 to 5.10 is what we can take a rough estimate. So most of the people in any school or any colleges you go and measure, they will be coming at the center point. The 68% of the time they belong to the center point, and the edges are the one of the edges you'll be seeing very people who are less than 5.5, and other edges you'll be seeing people way above 6 feet or even 6.5 feet also, like people like me. Now this is the same concept which is applied in the market profile also. Instead of this 68.2 range, this is a 68.2 range, right? This is a 68.2 range. What Peter Seidlmeier had taken, he had taken a rough measure, 70%. 68.2 and 70 doesn't matter much, right? So if I apply the same concept to the market profile, we can find something very interesting. It's the same concept here. So that plus or minus 1 standard deviation. So here it talks about where 70% of the time or 68.2% of the time, the plus or minus 1 standard deviation, where the price action is happening. This is where Peter Seidlmeier says this is where most of the trading activity is happening on a daily basis. And very few price actions are happening. Like price goes up, it is not staying much time there. It's not spending much time. Price is not spending much time there. So where price is spending more time, price coming into the zone and it is doing more activity, price is spending more time over here. And that is why the activity is getting more and more bulged around the center. But if you see at the edges not spending much time, number of TPOs are very less. If I count here, right, I'll be seeing only 2 letters over. If I count horizontally, if I count over here also 2 letters, 3 letters, or only 1 letter at the edges. So at the edges, you can see that the price is spending very less time. Now, this is not only in stock markets. You take currency markets, commodity markets, crypto markets, any kind of markets where buyers and sellers are auctioning on both the sides, any exchange, any trading instrument, of course, highly liquid trading instrument, not a penny stock though. Any highly liquid trading instrument, something like Nifty, Bank Nifty, ICICI Bank, HDFC Bank, Infosys, you can find this pattern very often, 70% of the time. And that is something which is make the intraday traders to take a better trading decisions. On a daily basis, it creates structures. For example, last Friday, we had seen almost 300 points down, right? A crazy downside fall. Even in that price action, you could have seen that structure. The structure was, you can see that the center point was, of course, it is not a kind of a bell curve shaped structure. It is kind of a double distribution kind of pattern. So this is one distribution. And then it creates another small distributions, 2 different distributions. But even on that particular day, if I try to measure how many times where the maximum price action happened over here, if I try to see at the center, you can see that B, C, D, E, F, G, H means almost 7 times. We have in a day like 13 half-an-hour bars, you can see letter A to letter M. So here we have almost 7 TPO letters, 7 times a particular price level is getting traded, even when the price is falling like 300 points down. Now this is something mesmerizing, right? So even if I go to Bank Nifty, right, you might find it even more surprising. The amount of letters which got traded. Initially, it got traded more letters over here. So you can see that if I try to compress, I'll be able to get a structure. So this is last Friday's structure, where Bank Nifty went down like something like some 400 points down, 400, 500 points down. Even in this case, you can see that the price action was very much bulged in this structure. Now, the question you might ask, why people are trading more there? Did anybody talk about, did anybody thought about this? If you would have been seeing the profile structure on a daily basis, you'll be definitely getting an such kind of information. Maybe I'll remove all those other informations. If I see even the top which has been made here, right? You could have been surprised to see how the top has been made and how many times the letter got traded. Such a crowded activity. Prices keep on repeatedly getting back and forth in that range. Price is coming down, again, it's going back up, again, price was hitting a fresh day low, again, getting back down. And majority of the expiry days are going to be like this only. 70 to 80% of the expiry days are going to be like this only. That is where most of the out of the money option traders are going to get bankrupt most of the time. People betting for the lottery tickets, they go bankrupt. Majority of the reason, for this one reason only. For this one reason why out of the money option doesn't make money most of the time. Yes, it does make, sometimes it does makes 20% of the time or 10% of the time. It does makes money. But majority of the time, out of the money options are losing is one of the primary reasons. All right, now how to understand this market profile? So what Peter Steidlmayer had given is like, he had given some basics to understand. What first 1 hour of price action is what it will be considered as an initial auction, which is nothing but the letter A and B. Letter A is half-an-hour period. Letter B is another half-an-hour period. So if I combine together, I'll be seeing an what? I'll be seeing an first 1 hour of price action. This is first 1 hour of price action. So maybe many software they'll be representing in a different manner. The tool which I am using, it'll be plotting in a kind of a vertical stripe with a combination of blue and red color combination will be there. You can see that blue and red color combination over here. That tracks the first 1 hour of price action over here. Right, so the first 1 hour of price action is called as initial balance. It is called as an initial balance because what Peter Steidlmayer had done, right? He went into the flow trading and he visually see the traders, what kind of traders are competing in the first 1 hour. You find something very surprising. Most of the time, the first 1 hour is dominated by the intraday traders. So they are the one who is buying or selling. First 1 hour, intraday traders are showing more interest in the markets. So first 1 hour is the range which is set by the intraday traders. The rest of the day, if the range is breaking, then some other traders who are having bigger money than the intraday traders, something like long-term traders or some positional traders or swing traders, they're coming and breaking those levels. So that is why he given the value, he given the name like initial balance. He given the term initial balance because the first 1 hour of price action, market will come into some form of an calmness, right? So the first 1 hour of balance is made by the, initially it is made by the, mostly it is made by day time frame traders. Doesn't mean like always first 1 hour will be traded by the intraday community itself. That is wrong. There are times, yes, when the auction, when there are serious situations are happening, Sometimes even long-term players also come into the picture. But most of the times, when I say most of the times, the auction will be kick-started and more intraday traders will be taking more control in the market most of the time, majority of the time. And then the valley area. So the valley area, it's called as a valley area because most of the people are finding value, that this is a fair price for the day. They're thinking that this is a place today I'm like to accumulate, or this is the place I'm likely to distribute. Most of the institutions are the one who is responsible for this auction, because when an institution is trading, right, they will not trade at one single price. So they have to trade at multiple price levels. If I'm an institution, if I want to acquire large shares of Infosys or Reliance, what I will do, I will split my shares. I'll say like 100 shares now, 100 shares in the next second, another 100 shares. So likewise, I'll be keep on procuring in the markets. Very slowly, steadily, I'll be accumulating in the markets. See, I cannot, if I want 1 lakh shares of Reliance, right, I cannot punch one single order and I cannot take it everything from the markets. If I'm going to do that, market will be ramping up heavily. So without disturbing the markets, these institutions will be slowly, steadily accumulating in the markets. So not only long-term players, even some swing traders also, who trade in very large quantity. They are traders, but they will operate like a wholesale traders. They accumulate in the markets very slowly, steadily. So because of these people, you can see that the market will be keep on auctioning in a particular day. In a particular day, market will be keep on auctioning back and forth, will be keep on auctioning. Means, in a simple terms, if you want me to say, the sideways markets. You might surprise to hear that sideways markets do happen because of the opposite party, the big traders. They want to slowly accumulate, they want to slowly distribute. That is one of the reasons why market goes sideways. Yes, there are traders, some big traders, they also chase momentum. That is why the breakouts are also happening. But those kind of traders that we are encountering are small in numbers. However, majority of the traders in the retail industry, they are breakout traders. 80% of the traders are breakout traders. And that is a hard thing to do. You know, right? Not, as I said, not every breakout is going to be a successful breakout. If it is successful, right, everybody would have been made money. Hey, the line cuts, you go and buy, and that's it. You make money, that's it. It's very simple. If this line, the lower line cuts, you go and sell, you make money. 80% of the people should be making money, right? If breakout trading is going to be successful means. But that is not happening. So we need to understand the auctions better. Why? If we understand the market structures better, maybe we can take better trading decisions. And here is a concept called point of control. The point of control is the center point where maximum number of letters are getting traded. So here in the center here, if I try to count the number of letters which got traded, if I try to measure horizontally, how many letters I will be able to see? E, F, G, H, I, J, L, M. Almost 8 times the letter is getting traded at the center point. Right, so 8 times. Think about it, 8 times. There are times first half an hour will be slowly rotating. So we call this a rotational markets because market will be keep on rotating throughout the day. Market will be keep on rotating in a day. So last Friday, what happened? You know, market does an initiative drive. So market pushed down, and then later on, market was doing sideways action, and later on, price went down, and it started doing more auction over here, more trading over here. So people find value at 2 different levels last Friday. So that is why we also get 2 different balancing activities. Here we had some one balance, and here we have another balance as on last Friday. But the balancing was there, even though market was heavily crashing down. And the upper tail is considered as a selling tail, and the lower tail we call it as a single prince. It is called as a buying tail. Because buyer, when the market is coming down, right, buyers initiate the auction at the tails, That is where the selling activity come to an end and buyers will start pushing the price back into the value area. Or at the day high, when the price is reaching the day high, the price will be keep on pushed up and up and up and up by the buyers until they lose control. They lose control in the markets and sellers will start taking control of the markets. So that is why we call this a selling tail. Right? So these are the building blocks of market profile. However, right, the initial balance is a very old legacy concept which has been used back in floor trading. Of course, now we are no more in a floor trading concept. So initial balance is very less used term these days. Of course, in Jim Dalton's books or Jim Dalton's videos, if you would have been going and seeing, you don't find the concept of initial balance anymore. Because back in those days, it was a floor trading. We'll get to know whom we are competing. Now, the best part is, even though so many buyers, so many sellers are there at a price level, we know that very precisely. We don't know who is controlling the markets if I just look only the price information alone. If I look only the price information alone, if I look only the volume information alone, I cannot clearly say what kind of traders are coming into the markets. So initial balance is more of an, I would say, like it's more of a concept which has been very less used. If in case if you want, you can use it, but it is more of a less used concept these days. Anyways, coming back to the topic. Let's move a little bit forward. So this is a comparison of side-by-side comparison of market profile with the normal distribution. So here the center point is what? Center point is mean, whereas here the center point is we call as an point of control. And likewise, the standard deviation part is here. This is the standard deviation, first 1 hour of price action. I mean, the 70% of the trading activity. The exact thing which is used over here, plus or minus 1 standard deviation. So you can try to equate normal distribution with the market profile. So since market profile is itself based on auction market theory, let's try to understand what the auction market theory says. It's a bit boring, but be with me. Now, what auction market theory says is like, let's say when a buyer and seller are entering into the markets, naturally they are trying to find what is the fair price for the day. Of course, let's say if you're going to a shop and you're buying a dairy milk, you know that the cost of the dairy milk is 10 rupees. But if you go to, let's say, airport or cinema theaters, you might be finding the same dairy milk selling at 20 rupees or 30 rupees. But still we will buy it. We know that it is beyond the fair price. You know, if I go to the markets anywhere outside, I can buy it at 10 rupees. But if I go to the airport, you might be buying at 30 rupees, right? So what the auction market theory says is like, the buyers and sellers, they negotiate through the online auction. When the moment market starts, they'll be negotiating those prices. The buyers and sellers, they'll be keep on negotiating. And their goal is to try to find the fair price for the day. Fair price where most of the time a particular level would have been traded by many traders at a certain level. Of course, you and me doesn't bother about fair price, but institutions, they do bother about fair price for the day. Because the people who are buying in large quantity, they need to bother about fair price for the day. If I'm having, let's say, if I'm having a requirement of 1 lakh shares, right? I cannot keep on going buy. I cannot keep on going in that way. I need to be very deterministic. Oh, this is the range, I want to buy it. If price is coming into this range, I will buy. Otherwise, I will not buy. That is a kind of commitment that they will give to themselves. Otherwise, what will happen? Their cost will go higher. Or maybe if suddenly they are thinking about buying, suddenly the market is crashing, they might finding is a value opportunity. Sudden breakdown, they will keep on buying aggressively. Otherwise, they will not buy aggressively. They will wait and they'll wait for the price to come back into the range, and then only they show interest in that price. That is how the value area formed on a daily basis. So auction market theory classify the price into two types. One is fair price, where more buyers and sellers agree to do the transaction. That is what institutions, market makers, all the big traders, they show their interest at those levels. An unfair price. So these are the places very less traders initiate their transaction. Sometimes emotional traders, they get stuck in those places. You would have seen that price action happening sometimes like this. The market might be doing a wavy price action, and suddenly it breaks down and everybody, it catches everyone's attention. Traders will getting into short and short and short. And all of a sudden we start seeing like a price will start moving back to the center. Now what would have happened here is, I'll tell you, the price would have been went down below the value area low. So let's say if I try to draw a line here, the value area would be looking something like this. Price would have been went down below the value area low, and it would have been being given a value opportunity to the traders, investors, big investors, by finding it as an attractive. I'm thinking that I should buy Reliance at 2,500. Now it is coming to, I'm getting at 20 rupees cheaper. So let me go and buy aggressively. They'll start buying aggressively there, because suddenly market is giving an opportunity for them to acquire the price lower. What would have been happened most of the time is like an emotional trader, they get caught in this kind of price action most of the time, 70% of the time. I'm not saying like not every time, but 70% of the time, emotional traders, whomever willing to chase the markets, they get trapped most of the times. If you go back and study the structures, right, you will get to know how the traders get trapped. Or maybe once we might be a victim of those things also. We might be seeing a calm markets. Suddenly the price would have been broken down. That could have been my support would have been broken, or yesterday's low would have been broken, or 3-day low would have been broken. And suddenly what would have been? Suddenly the market will start ramping up. Because other traders who are willing to buy in a large quantity, they are finding it very interesting. They are getting they thought like they want to acquire only Reliance at 2,500 rupees. Now price is going 20 rupees down, and they're finding it very much attractive. So they don't want to miss the opportunity, because if they are going to miss the opportunity, they start delaying. Other institutional traders might find it. So they'll aggressively, they start buying from there. So that is why price will mostly rotate. The buyers and sellers agree together to do more transaction. That is what it results in the point of control. And that is what we call as the markets are in equilibrium. And that is what we also say, like which is where the zone where value area is all about. Unfair price generally happens above the value area, either above the value area or below the value area. Price will spend very less amount of time. How traders can make use of market profile? See, one of the major traders, if you talk to any trader, you can find something very much interesting. They want to know about smart money better. But none of the traders, they don't want to know how the exchange itself functions, how the auction happens in the markets. So majority of the time, the traders want to avoid sideways markets. But the beauty is like you cannot avoid sideways market, because that is what filled in the market 70% of the time. So if you want to be a professional trader, you should learn to trade the sideways markets. Of course, you should trade the breakouts also, more than a breakout, because breakout happens only 30% of the time. If you are a full-time trader, whether you like it or not, there is a 75% chance that a market can go sideways. So in that case, what you will do? Simply sit and see the markets. Or maybe we can, what we can do is like we can go and trade where the breakouts are happening. So today I might be trading Reliance because Reliance is showing some breakout. Tomorrow I might be trading some other stocks. That is one way. If I am trading only Nifty, Bank Nifty, what choice I do have if I'm a full-time trader? I don't have any choice, right? Whether I'm liking it or not, if the market goes sideways, I have to accept that yes, market is going sideways, and then I have to learn to trade the sideways market. Maybe my opportunity might be small. But when the markets are trending, if I understand that yes, the markets are trending, the participations are getting aggressive, I can go and trade the momentum trading also. So one major thing market profile traders, what they can do is like they can understand which direction to trade. Or should I have to trade the sideways markets, or should I have to trade the directional markets? How big the trading opportunity? This is one of the key important things. Is the opportunity small or if the opportunity is big? Now, why I'm telling you is like there are sideways market, the opportunity, still market will be trending, but it will be small trends. But when momentum trading is happening, wilder fluctuation happens in the markets, very big opportunity happens. Right now, last 2-3 days, you can find that markets are very volatile, means opportunities are getting very bigger, and markets are also getting more directional. On a daily basis, markets are swinging like 300 points, 250 points, very easily markets are swinging. I'm talking about only about Nifty. In fact, Bank Nifty is even more crazy. It's getting more crazy these days. But in a very calm market will not give very bigger opportunity. Opportunity will be very small. So one have to come up with a different mindset to trade such kind of markets. So if the trading opportunity is going to be small, of course, you have to think differently. If the trading opportunity is big, we can go in a very aggressive fashion. I can change my aggressiveness of the trading dynamically if I know what is whether the trading opportunity is big or small. Of course, this is what a market profile is all about. What I do classify is like I do classify market profile into two categories. One is micro structure, another one is a macro structures. Macro structures are big structures which is getting created for the day. Micro structures are tiny piece of information. Market profile also gives tiny piece of information, which are very helpful for the traders to predict the targets most of the times, where the market can move and why it can move. Most of the microstructures can be used as a entry points also. If you know these microstructures are happening, there are times you know that where smart money traders are entering. Microstructures also help traders to understand where the dumb players are also entering. In fact, market profile is one of the very first study to talk about both what smart money is doing, at the same time what dumb money is also doing in the markets. Macro structures, we can classify them into a variety of categories: balance, excess, imbalance, poor high, poor low, incomplete auctions, single prints, poor structures. This becomes a part of the structure here. You can understand the markets even more better. For example, one of the day, here, right, we had a very clear structure, which is like on the expiry day. This expiry day, one day before expiry, Wednesday, what happened? Price opened with a big gap down, a huge gap down. You know why this gap down happened? This gap down happened on 14th of September. If I'm not wrong, previous day, the price was trading at 1800. Previous day, which is like Tuesday, price closed at 1800. And the very next day, price was opening like 17,800 levels, approximately around 17,800. It was almost a 300 points gap down. 300 points of gap down. The market is making up. Imagine such a kind of huge gap down. Whom do you think, what kind of traders will come and trade? If you would have seen this repeatedly, right? Anytime, have you seen in the markets anytime, whenever the markets are opening gap down like 200 points, 300 points, You know what happened first? First thing always happens is like emotional traders, the traders who is having a lot of anxiety to participate in the crash. They are the first one to always step into the trade. They want to go and short the markets. They don't think about anything. Just because the market is opening gap down, how many times you think yourself? So maybe sometimes some people might be a victim of those things also. When the market is opening with a huge gap down, a lot of traders will be having that anxiety. Oh my God, the market is going to crash. I think today market is going to crash like anything. So I'm going to step into the markets. I'm going to make some money out of it. Traders will blindly, they will go short. Those are the traders who don't have any idea about how the auction market theory works. They straight away jump into the trading. They'll think that it's going to be a breakout trading. But majority of the time, what we will see, like price goes to the opposite side, sometimes very aggressively, very vigorously. We don't have any reason why the market is going up. And that is the nature of the market itself. The nature of the market itself, chaos. You know, right, why the market opened gap down on that day? Any idea? 14 September? Anybody? You can just type it out. In the chat box, you can type it out. There's a chat box down there. 14th September. Yes, it is a news-based gap down. Of course, if the market is opening 300 points, right, definitely there should be some sort of a news-based. In US market, the inflation numbers are getting released, right? So because of that, US market went down. I think US market was down by some 3.5%, up around 3.5%, and Nasdaq was down by some 4 to 4.5%. A crazy down move in the US market, and that panic is getting triggered in Indian markets also. So many people, what they will think, oh, Indian market only fallen 3%, 300 points only. That means only 1.8 points, 1.8%. So let me also go on short. Anyways, it's supposed to break down by 3%, right? And naturally, any trader will be thinking like that only. But market is beyond that. Market has its own mind on its own. Now, this is a repeated thing. If you would have seen the behavior many times, if you haven't seen the behavior, for you, it will be looking like a breakout trading. But if you would have seen the behavior, I would say like out of 100 bigger gap downs, if you go back in time and you measure hundreds of bigger gap downs, I'm talking about a 200 points gap down or 300 points gap down, every place you can find only one thing very interesting. Whenever such a big gap down is happening, it's mostly because of some sort of news. It could be a local news, or it could be some international news, or because of some geopolitical tension. I'm not saying like not every time it will happen, but 90% of the time, emotional traders who don't want to miss the opportunity, or who are finding it as a freaky price action, they are the first one to get caught in the market repeatedly. It's not the first time it happened. Sometime back also it happened the same way. So market rallied back up. Market rallied back up. And this is not the first time. Same month, this is the second time in fact. One more time we had such a big crazy gap down. Every time that kind of gap down happens, right? You have to be asking the question, am I going to buy it immediately? I mean, am I going to sell it immediately? Or should I have to wait for the market to settle down? I think one another day, we are having that big gap down. So here again, when it happened, yeah, here. There's another place. Here also almost a similar thing was happening. It's not a gap down though, but it's kind of a very big lower opening. Now almost here, what is happening here? Here, one of the day price was closing at 17,850. Around 17,850 is what the market is attempting to close. Not an exact number, but I'm just putting a rough number here. The very next day, again, price is opening with a big gap down at 17,550. Imagine 17,550, 17,550. Now, what should be the first response if you are seeing this? Forget if you are selling or not. First thing what you should not do is you should avoid selling in the first hand. At least you should wait for some information. Try to understand what the market is trying to do. You can take a little break and then you can think. So taking a long It's up to you. Like, so 90% of the time one is going to get benefited most of the times. But if you want to short the markets, you have to think 1,000 times that why you want to short the markets. Because what happens is majority of the time, as I said, when such a huge gap down, you can see that volumes will be running huge. Opening first 5 minutes, the lots will be flying like 25,000 lots, 30,000 lots, 60,000 lots. Such kind of volumes will be flying when such a huge gap down opening is happening. Because so many anxious traders, they want to short at the market when the market is opening with the 300 points down. And the first response, what you will be getting here is like the price immediately start going against them. So this is something maybe if you are a routine trader in the markets, you know this kind of behavior, or at least you would have seen this behavior so many times. For example, I'll tell you a very simple example. There are many times you would have seen that pre-market a stock is supposed to gap down by 10%. Some bad news would have been there. It's supposed to gap down by 10%. That is what the pre-open would have been shown. The moment you try to short, what will happen? A lot of anxious traders will be watching that information. They're going to think like, oh my God, the market is going to go crazy. The stock is going to go crazy down 10% circuit. They try to short the markets. End of the day, you would be seeing like the stock would have been recovered, most of the losses from the low. Right from the start of the day, the market will start recovering back. Now, such kind of behavior, you can find it very frequently, and definitely Market Profile will help you to understand this kind of price action in a very easier manner. So, but the context, what I want to talk about is not about the gap down. The price open gap down. Price rallied back up, a crazy rally. In fact, Bank Nifty done a super crazy rally. But at the end of the day, what I'm seeing from the structure is like, I'm able to see a couple of macro structures, which is very visual information. I'm able to, if I see this as a building, I'm able to see a lot of anomalies in between the building. So these are tiny, tiny gaps in between the structure, small gaps. So these gaps is what we call as anomalies. If the gap is such kind of gaps, generally it doesn't happen. You will be seeing a very calm, balanced structure, not much of a structure over here. Now, these kind of structure we call as an asymmetrical structure. Asymmetrical structure means if you consider as a building, the building has a lot of gaps. If you see a well-distributed profile, a well-distributed profile will be looking something like this. You see this? It's a well-distributed profile, a kind of a bell curve shape. Here also almost a well-distributed structure. Maybe it might have a little bit of holes, but not much. But on this day, I'm having almost 4 to 5 gaps in between the structure. So that's what we call as a poor structure. So those are the places emotional buyers are getting into the markets. So buyers are stepping in because that is what it generally happens. It's a traditional trading behavior. Whenever such a big gap down is happening, always the market tend to recover most of the losses. Somehow the buyers are rescued most of the times. At any big carnage, buyers will be mostly rescued, and most of the time sellers will not be rescued most of the times. Most of the times, if you're booking at the opening itself, if you're having options, if you're booking at the opening itself, you will end up making most of the money. If you fail to do so, maybe a 40 rupees options, it becomes 80 rupees at the opening. You will again have to square off at 20 rupees or 30 rupees back. If you're missing that gap down. At the opening is where you will get the most of the time. I'm talking about 80 to 90% of the time. This is what it happens mostly. Next time when such a big gap down is happening, you try yourself. So, but this is where we are seeing a poor structure. One form of an emotional traders. The buyers are getting more emotional because that particular day, even though price opened with a huge negative context, end of the day, most of the losses has been recovered. In fact, at some point, right, Nifty went positive, almost 7 to 8 points positive. I've seen somewhere middle of the day. Lately, again, price slided down and it closed with some decent negative points. Bank Nifty was almost at very close to all-time high. The very next day, in fact, it was even hitting an all-time high also. So Bank Nifty was doing something differently. because Bank Nifty is not having the structure. The structure of Nifty is mostly differs from on a daily basis. If you see, even though Nifty and Bank Nifty looks like it is moving together, but most of the times you can find that Nifty will form a different structure, Bank Nifty will form a different structure, most of the times. So different interpretation, different way of thinking. If I trade Nifty, I have to think differently. If I trade Bank Nifty, then I have to think differently. So this is a very crucial information for me. And the moment market is coming down, so the next day what happened is like price opens here, it went up first, almost within first 5 minutes, the market went up, first 5 or 10 minutes, market went up. Rest of the day, they started clearing all the anomalies. In fact, I anticipated markets clearing those anomalies. So if we know this kind of tiny piece of information, so what market profile generates is, we call this a market generated information. It generates this kind of piece of information, tiny piece of information, which helps traders to take better trading decisions. As I said, it will not give you buy or sell. It tells you what kind of trader I'm competing with. Here I can understand that I'm competing with emotional traders. And that is what it makes me to think like, okay, then I should be holding shorts. I should be expecting entire anomalies, all the anomalies to get repaired. We call this a repaired, means price will come back and clear those levels. So those are poor way of auctioning. It's not a good auction. It's a bad way of auctioning. Generally, when emotional traders are coming and trading, it will not be a smooth auction. When institutions are coming and trading, or when wholesale traders, when short-term traders are coming and trading, you'll be finding this very calm structure. When I don't find this calm structure, many people, they misjudge the market activity. Many people, they think, oh my God, some big traders, they come and bought over here. That is not true. End of the day, what they will think, they look into what FIs have done and DIs have done. They will think, oh, FIs only, they bought this markets. So that's a wrong idea, because an institutions will not trade like that. An institution will not like to trade like that. Because on a daily basis, like they'll be getting crores and crores of money. Using that money, like they cannot be keep on moving the markets every time. They will be slowly, without disturbing the markets, only FIs and DIs will be presenting in the markets. So only if there is an opportunity, if there's a sudden value opportunity they're getting, if they're getting, let's say, you know that the dairy milk price is 25 rupees. Suddenly, in an airport at 25 rupees, dairy milk, if I'm getting at 10 rupees, what will happen? Or for example, let's say a brand new car is coming at 10 lakh rupees. Suddenly, if they're offering discount, Diwali discount they're offering, what people will do? People will flock there, right? Why? Because they know that the price is 10 lakh rupees. Suddenly, I'm getting at 7 lakh rupees. So I will go and buy it immediately without any thinking. Am I right or not? That is how we find value, right? You know that you might be finding a phone very much attractive. Let's say an iPhone is coming. You know, what is the cost of an iPhone? On average, it comes at 1.2 lakh rupees. Suddenly, if you're seeing like the Apple itself announcing a discount, or in a Flipkart, there is a big billion sale is coming in. Suddenly, there is a deep discount is offered. Many people, definitely, they'll try to flock. Not only iPhone, let it be any kind of phone it is. If you're valuing that product, and if you're getting at a cheaper rate, definitely the aggressiveness will be there. Even though you don't want to buy it, just because they're offering a discount, we'll go and buy it. The same thing happens from the institution side also. Generally, they don't have the intention to buy it aggressively. But suddenly, if the price is giving a value discount, they will take that discount in the markets aggressively. Because if they are not going to take the discount, they know that some other institutional trader will pick it up. All right, so what are the other things market profile is capable of? As I said, market profile study, right? It requires a little bit of patience. Many people want to learn it in 1 or 2 days, but that is not the key here. So you have to learn a lot more things. You have to learn about market confidence. You have to learn about trading inventory. You have to learn about where the weaker hands are coming and playing. You have to learn about when the trends are happening, when the trend reversal will happen, which is a successful breakout, where the price could rotate, or where the price could do multiple sideways activity. And of course, Very rarely we also focus on support and resistance. It's not on a daily basis, we don't focus on support and resistance, but certain patterns are forming, certain profile patterns are forming. We'll also try to identify the support and resistance places, like every other trader. And of course, what market profile teaches is like odd-based trading. So when a possible short covering can happen, or when a strong liquidation can happen, and why it happens. The why is the question. Market profile helps you to understand those information. That's a key basic thing why the market profile do exist even now. So, okay, so market profile is a concept. More than studying can be done within a week or so, but practicing is what it requires. A little bit of hardly 1 or 2 months is definitely required to practice. So one have to give some deeper time commitment. Otherwise, if you see this as yet another tool and you want to practice, you will at some point in time you will keep losing your energy and you will start giving up. If you want to practice market profile, you have to deliberately practice. Otherwise, you should not be practicing at all. For a namesake, I also want to read market profile. That doesn't work because it takes time to adjust to this new information. These are new information, probably we never heard of. So it requires a little bit of patience to unlearn our old thinking, to take advantage of those unconventional techniques using market profile. All right, so what I am thinking about the markets, that what the ultimate thing that we generally speak up at the end of the session. So what I'm thinking is like market had formed a top in Nifty, and Bank Nifty also formed a top. So Bank Nifty also formed some sort of a top. We call this a kind of a dual momentum auction reversal. So last couple of days, the market has been, though it was bullish, that bullishness has been stopped post the US CPI numbers, which US market also taking it very seriously. And it is also reflecting in the Indian markets as well. That is there. But even then, US market is behaving like US market, Indian market is behaving like an Indian market from an intraday perspective. If I try to watch the US market and I'll try to replicate the same in Indian market, right? Anybody can do that, you know that. So if you don't try to replicate the same way, it's a bad idea to do that. Maybe if you're an experienced trader already, you know this. So both Nifty and Bank Nifty had formed a pattern. So something like Nifty had formed a pattern called G2 formation at a major swing high. It's one form of a top which we monitor. US market also around 4,100 levels, it formed a G2 high and then it started falling down from there on. Which I already explained in one of my YouTube video. So you can go and watch it out, youtube.com/user/market calls. You just type market calls in YouTube, we'll get to see the latest in video where I talked about those scenarios, why Nifty had formed a top. In fact, we also run our own trading community called Slack channel, where we talk about market profile. Whenever there's any interesting information is shaping up, I'll also go back and talk about those market activity. So here, September 15th, Nifty G2 high odds holds. Means prior to that itself, we are talking about it. When we've been talking about on September 14th. September 14th is where that big gap down is happening. So on that day, so G2 high formation in Nifty and Bank Nifty, if the sentiment turns negative, so closing sentiment, if it remains negative, and tomorrow's opening sentiment too, if it remains negative, we could conclude a short-term top formation. So that is what, and we are confirming the top on September 15th, Nifty G2 high odd holds. Bank Nifty yet to confirm the top. This is on September 15th. And September 16th, we're also having that information that Bank Nifty also having a higher odds of Bank Nifty forming a top, a kind of a top we call it as a dual momentum top. So this is how the dual momentum top looks like. So this kind of patterns, right? We can use this to identify. This is also one form of a market generated information. Now, what I had measured is like all these 10 years, I've been observing market profile and order flow for the last 10 years. I've been observing various top formation and various bottom formation. I also formulate how a top could look like, how a bottom formation could look like. Almost I identified some 20 to 25 top formation setups. So one among them is what? It is playing out a G2 high, one form of a top formation, dual momentum top, another form of top formation is what I've been thinking about. So where the price could move next? If you know that it's the market had topped out, though the market had done an top formation, still the auction is still a little bit challenging. Last Friday, the sellers are not very clear about the selling. If you could see the structure here, a couple of micro reference level has been formed, a kind of a weaker reference formed around 17,740 levels. And lower side also, there are a couple of weaker levels. So one another weaker level at 17,440 and then 17,220. So in fact, I also have a sheet. I do maintain a sheet. Let me pull up the sheet here. I do record those information in the sheets. So here are the levels. So if at all anything on the downside, 17,440 and 17,250 is possible in the next week. And anything on the upside, we can only expect a limited upside activity. Like I said, the top is still in place. So anything on the upside, I can expect anything maximum up to 17,440, and anything to the downside, it can go up to like 17,220 kind of levels. 250, 220, 200 kind of levels. It's a possibility to the downside. So which is what I'm just thinking at this point in time. When it comes to Bank Nifty also had a similar top formation, but still last Friday's activity, it's not looking great. So there are a couple of micro informations happened over here also. So one of the level where the micro information happened is like at the I period high, it happened. And also not only there, but also one more information, like even at the J period also, I mean F period also, it had some very visual information. So not so serious traders, some dominant traders, they started trading around those levels. If at all the market can go up, they can go up to like even they can go and break the highs also. But when the price is coming down, it's getting very dangerous here. How dangerous, I'll tell you. They can go and breach the AB power low. And that can happen very much faster. And that AB power low is coming around the 39,300 levels, which is way, way, way down. It's still another 1,500 points down from the current levels. So Bank Nifty is getting more dangerous. Upside, yes, upside odds are looking very limited, but downside odds are getting very aggressive. See, that doesn't mean like Monday at the opening itself, you have to go on short. That doesn't mean like that, right? But the risk is seriously getting on the downside for the next week because there is an AB power low is there. Generally, it gets cleared very faster, and I think it's high time to go and touch pretty much faster towards the AB power low. The thing is like how it's gonna go up. It's what it matters. First, they will gonna break the highs and then they're gonna go down, or they're gonna break the lows and then they're gonna come back up. That is a question which we have to leave it to the markets. But the odds are saying like pretty much higher that next week, the chances of AB power low increases a lot. All right, I'm sure you might have some fair idea about what market profile is all about. Some people might like it. I know that some people are not going to like this because definitely it's a different way of thinking. Not everybody I'm also expect them to attach towards that. I say thank you for coming by and attending the session. I hope you learned some of the very basics of market profile. Just go back and search about it. You will get better ideas about how to look into the market profile in a very deeper manner. Thank you.